Good morning, afternoon, everyone. Welcome to the True Potential Do More With Your Money podcast. We're on episode 56. We'll do the usual like and subscribe if you like listening to us. We're joined by a star panel today. We've got Mr. Chris Leyland, Steve Hutton, and we've got one of our advisors, Loraine Hunt. Welcome, Loraine.
Hi.
And Loraine, we'll start with you because it's your first podcast. Tell us how you got into financial services and tell us a little bit about yourself, and we'll take it from there.
Okay, thanks, Jamie. Well, I worked with HSBC for many years, and I got involved in financial advice in '95, quite a while back now, over 25 years. And I started at various roles, and eventually, the last 10 years, I carried out roles as a private client manager and then later a commercial IFA. So I worked a lot with commercial clients and business owners. I then qualified as a chartered advisor in 2013 and associate with the Chartered Insurance Institute. And then I left HSBC Group to join True Potential.
Fantastic. I think there's a couple of points there. We'll maybe ask some questions about your commercial background later on. But I must say, I was going to talk about this at the end, but I think it's very, very interesting. I think, Steve, you will like this. Speaking to Loraine yesterday about a podcast, I think this should be class, but Loraine used to play professional football and has 15 England caps.
Well,
fantastic. I am right there, Loraine. Is that and is there an FA Cup medal in there?
Oh, yeah, a few FA Cup medals, but a little bit of a correction there, Jamie. I never played professional because when I played, it was strictly amateur.
Right.
You know, the best you got expenses, and we did get some corporate sponsors, but we weren't affiliated with the men's teams back then. We had our own football association, so it was amateur.
Yeah, interesting, but very impressive having some England caps, though. Steve, you never got that far, did you?
Well, I got schoolboy caps, Jamie, if you don't mind, but I never went beyond that, I'm afraid. What position did you play, Loraine?
I was a defender, so I mainly centre half and sometimes right back, left back. Well, I played all across the back four, really. I was at what you will remember, but I was inside right. So defenders, and I never talked to them. All the keepers, Loraine, I didn't want anything to do with them.
I think that's
tongs on my hair and things, and I wore very short shorts, and I thought it was beautiful.
You were, Steve. You were fantastic. I thought that was really interesting, actually. Loraine telling me yesterday, just the FA Cup medals and the England caps, amazing. Right, we'll get back to the podcast. So today we're going to be talking about all about financial planning and the importance of planning for future, but also planning of your current circumstances at that point. But we'll start off with the usual market update, Mr. Leyland. If you could tell us what's happened with the markets this week.
Yeah, absolutely. Cheers, Jamie, and hello, everyone. So just looking at what's happened within equity markets, you've seen Japan's been really strong. So it was up 2% this week. You got Japanese economic data coming through much stronger than expected. So the Japanese economy grew at an annual rate of 12.7% from October to December, and that marks the second straight quarter of growth. So for me, that really illustrates the recovery that Japan is experiencing coming out of the pandemic. And in some ways, that's a bit of a theme. If we move on to the UK has actually posted positive returns. And what you've seen is quite a lot of company results come through this week. And I think the most interesting ones for me are probably the miners. So you had Glencore, BHP Billiton, Rio Tinto all reporting, and all benefiting from the incredible uplift since March last year in the iron ore price. So you've seen continued demand from Chinese steel plants. But what's most interesting is actually they're now paying dividends. So the companies are confident enough in the environment that they're now returning cash to shareholders, which is actually a really big thing. If we look at the US, maybe a little bit more of a mixed bag. You've seen the S&P outperform the NASDAQ. What does that mean in layman's terms? What it means is that you've seen a broadening out of leadership from the US tech stocks that did so well in 2020. And I think, if you look year to date, equity markets have been strong. You've got global equities up probably 3% year to date, which is a fantastic result in 6-7 weeks. And I thought about this and I thought, well, what is really driving investors to be so positive right now? And you've got a few things in there. You've got the continued vaccine rollout. So obviously we've got the UK, the US leading in that regard. You've got basically ultra loose monetary policy. So what does that mean in layman's terms? It means you've got low interest rates, you've got continued bond purchase programs, so quantitative easing going on in the background, and that's not going to change anytime soon. You had the Fed minutes come out, and basically they guided that equity, so they guided that interest rates, low interest rates are here to stay. And then finally, you've got governments on the sidelines ready to provide support. You've got the potential for that $1.9 trillion stimulus package that Biden's tabling to come through. So for me, overall, things are fairly positive right now.
Good stuff. I think I was reading a couple of articles last night, Chris, about Keir Starmer's plans in terms of the sort of the amount of savings that has been sort of cash savings that's been kept during the pandemic, and trying to create a sort of national savings product that will sort of help build the economy. And then the Conservatives come back and said, oh, well, that was our idea.
Stole our idea.
Yeah. I don't know that's probably one for you as well, Steve. What's your views on that in terms of, because obviously there's lots of savings that they believe there's the same amount of savings in people's accounts because they haven't been buying. What's the best way out of this in terms of helping the recovery?
Well, I think the first thing you've got to think about is people's psychology and why they're in cash. And I think people have this, and I don't mean rude to people here, but they have a misconception that cash is a very secure, safe asset, which, okay, it's not an equity and it's not a bond, but to have that conception that cash is safety. And I think if you look at what's happened obviously we saw what happened in markets last March, and April, but they recovered. That will have been a shock to a lot of people. So they may have defaulted to cash as well as spending a lot less. So they've built up cash reserves. You've got to inject here the ogre, which is inflation. Now, I'm pretty sure the only person on this call that can think back to the 70s and think of when inflation was rife and things like that. Interesting on that, and just as a bit of an aside, because I know you like me to put some of my fantastic anecdotes in here. I can remember back in, I think it was 76, when potatoes went up because of inflation and a potato shortage. We had a potato shortage because of a bad crop, and I remember sitting at home with this ridiculous discussion around the table about, how many bags of chips could the fish and chip man make out of a sack of potatoes, and rationing that, charging 10p for a bag of chips was absolutely scandalous. That's an aside and probably not interesting to anybody outside York that doesn't eat fish and chips. But no, you've got to look at inflation. And if you look at compare inflation with savings rates at the minute, I was looking the other day about what the best savings rates are. Now, you might get some headline rates of 2.5%, but it's on £1,000, so you can discount that because it's for your first £1,000. Generally, you're getting about 0.5% maximum if you can get that kind of rate. And you've got inflation, all right, the government's target's 2%. If you look back at sort of 2010, 2011, when it was 5%, if we're looking at inflation between 2 and 5, Chris will tell us if there are inflationary pressures coming into the market. But even if they stay within the government's target at 2%, that's eroding your money. So cash is not a safe asset in that sense. If you were to keep it in cash for 20 years, you could be losing up to nearly a third of your capital. It's not safe leaving it in cash. You then look at, and Loraine can tell us about the FSCS limits of £85,000. You've got protection on it per institution. But if you've got a balance over that, you really should be taking financial advice to look at what you're doing with your money, because leaving it in cash is not the safe haven that you might be, not unwittingly to a degree, and that's why you need financial help and financial advice. But if you're leaving it in cash, it's not a safe haven. And inflation, if it does pick up, I don't know if there are massive inflationary pressures, but we have this perfect storm where savings rates are pitiful. But even inflation within the government's target will crush your savings. You'll get cash rot on your portfolio if it is wholly in cash. So please, look for advice. Go to an advisor such as Loraine and sort of reach out to us, because we can help you with that. Chris, you might want to fill in a bit on
I think, talk a little bit about that and maybe markets as well in terms of how inflation affects it.
Yeah, sure. So, obviously we had the UK inflation came out earlier this week, came out at 0.7%. So Steve mentioned the 2% target there, so it's still much lower than the 2% target. But I guess what's the outlook for that? Well, firstly, inflation will rise this year, and it's a function of the fact that prices created last year. So remember things like the oil price last year actually went negative, which is just incredible. So just from a function of the fact that prices fell during the pandemic, you're going to see inflation pick up in the UK. Now, we know that that's just a fact. I think, just really echoing what Steve's saying there is that, it's an incredibly difficult time for cash investors. The reality is you've got low interest rates. That's not going to change. We're not going to see interest rates at 5%. You're not even going to see interest rates at 2.5% in the next 5 years. The reality is we're in a low interest rate environment, and that's the way it's going to stay for a long time from now. And what does that mean? It means that you're getting nothing on your cash, and inflation's going to erode that away. Inflation, we know, will get higher. It's below target. The Bank of England, they want it to be at that 2% target. So we know inflation will get higher. We know inflation will get higher because of that cratering of prices last year. So for me, the only way that investors can hit their goals is to be investors and to be invested in a diversified solution such as the True Potential portfolios. I think, if we look at inflation further out, what is it that we see? And you can get what I describe as good inflation or bad inflation. If you get strong economic growth and inflation, that's great. That's kind of normal. You know what I mean? That's what you want. If you get low economic growth and inflation, then that makes for a very difficult environment overall. Now, what we see for this year is strong economic growth. We see a strong recovery coming through. We do see inflation picking up. If we look further out, which obviously is a little bit more difficult, there's less visibility as you move long term. We don't see inflation getting out of control, but we do see inflation coming much closer to that 2% target overall. So for me, if you're an investor, if you're sitting on cash, the real key message here is that it's going to hurt. You're not going to be able to hit your targets if you stay invested in cash. You have to take some sort of risk.
Yeah, I agree, Chris. Brilliant. Thank you. So we'll get on with a little bit about the topic of the podcast today, which is about financial planning. And this financial planning can mean a full ream of things. And we'll start with you, Loraine. And if we just start from, many of our clients will be approaching retirement and thinking about their retirement options in terms of what's the best sort of way of taking income, taking scheme pensions over annuities, etc., these sorts of things. And I suppose from your experience, Loraine, how do you plan with your clients in terms of their sort of goals and objectives when it comes to retirement?
I think it's important to spend quite a bit of time analysing their expenditure in detail, and then obviously their expected expenditure in retirement, which can be very different, and talk that through with them. And once you've got that, you can calculate a capital value as to what they're going to need, excuse me, in retirement. So, for example, there are different tools that can be used, but a rough guide might be, say, 25 times annual expenditure or something like that. By calculating that, we can identify any shortfalls. So analyse their statements, any other savings, ISAs, savings, investments, and existing pensions, of course. And then that gives us a shortfall.
Yeah. I think you make a valuable point there, and it's something that if you've saved all your life in a workplace pension, or you've got a DB pension and you've maybe transferred it or something, you've got to realize that this pot of money has to last you for the rest of your life, and taking sort of larger withdrawals that aren't sustainable out of your plan can have a big effect on your later plan in retirement, which is why I think it's really important to, I suppose, to phase your retirement and understand, well, how much do I need? How much am I spending now? Will that be the same in retirement, as you said, Loraine? And when we speak to clients, a key area is you don't necessarily, your money might not reduce early in retirement. You might find that you might want to do more holidays, or but you might have less time in the car, so there's less petrol. So you're right. I totally agree with you from the expenditure perspective, but it's worth speaking to your advisor about this and going through that plan to understand you definitely do have enough money. I think you'd agree, and it's never too late. If you're thinking about retiring in 10 years' time, it's never too late to start saving now, or putting that little bit extra away. It can make a huge difference.
Exactly. And obviously at this time of year, with the tax year ending fairly soon, then it's important to speak to your advisor and see whether or not you can top up any existing provision, be it pension or ISA.
Yeah, I totally agree. And actually, that's a good point. Steve, what's you always get the ISA versus pension question. We've talked about this so much on these podcasts, but allowances are just coming up. I think just give us a little bit on the importances of actually just sort of taking advantages of these allowances, and where's the best place for your money to go and be invested.
Yeah, you'll have heard on previous podcasts how we bang the drum, and I bang the drum about using your allowances. They are, generally, if you don't use them, you lose them. That's not strictly correct across all your pensions. You can, if you get a financial planner, they can help you pick up some previous year's back allowances. But generally, use them or lose them. And there's losing what you have now, but also, as keying into Chris's point, the government have borrowed a lot of money. I think it said last month they borrowed 8.8 billion, which to the likes of us probably have no idea what that means. It just seems a heck of a lot of money. However, you just realize that they're borrowing so much money, quite rightly or wrongly, however you look at it, but they're going to have to pay it back. And equally, these allowances are very, favorable at the minute. So if you're not using them, they're not going to get any better. They're not going to get any, more beneficial. They're probably going to start squeezing pension allowances. That's always a rumor, but it would be a natural kind of attack. So use them. So for me, pension versus ISA is a moot point, in the sense that, for me, I would always go pension first, because you're getting actually a tax rebate to go in, if you like, whatever you call it. If someone was to say to me, if you invest in this pension, you could have up to a 45%, kicker in your first year. Well, that just seems too good to be true. Well, talk to a financial advisor. You could get 20, 40, 45% in your first year just by way of the tax relief. It's an absolute crime if you miss it, everybody. Using ISAs, then you're growing in a almost tax-free environment, and at the end, you've got, so you can take your money out. You should be looking at these two allowances and getting advice on them if you need them. If you've already done them before and you haven't topped up, then please, we all forget to do things, but just write a memo. I use my little book here. Do your allowances, but don't forget the tax year ends on the 5th of April. Time's running out. Get on and do them, and talk to your advisor about all your unused reliefs. Even CGT. CGT is always in the news. That's not going to get in more favourable because it's perceived as the tax relief of the rich. But you've got a tax allowance there, husband and wife. You might have some stocks in a share portfolio, for example, where you can utilise your allowance to get them into a more diversified, less risky, more sleep at night type environment, like our TPP portfolios. So there's quite a lot to think about when looking at tax allowances. So if you've never used them before, please consult a financial advisor. If you need to top up, consult your financial advisor. They may tell you a very easy way of doing it, or you might need to take some advice. But sorry, Loraine, I'm probably always moving into your territory, but it just seems a crime not to use your tax allowances at this stage, and particularly this year. That's what I'm thinking.
Yeah, definitely. Totally agree, Steve. Steve, just while we're on you as well, I think obviously you look after a large number of advisors within wealth management, as your role as managing partner of True Potential Wealth Management. How important is it to seek an advisor, especially when it comes to planning? Planning your financial arrangements, whether it is coming from starting or retirement.
For me, Jamie, and everyone will say, "Oh, of course you'd say this." I'm not a qualified financial advisor. In the past I have been, but it's lapsed and moved on. So financial advice has evolved. However, I work with 700 of them, such as Loraine. It's crucial, I think, if you've got tax matters, or you've got investment questions, or we talked about allowances, you should reach out and talk to your financial advisor. If you haven't got one, contact us and we'll put you in touch with one. If you have one, then reach out and take them, because you make a little error and you miss some tax advice, you miss a tax allowance, or you go down the wrong route. it can cost you in the future. And as we sort of tie it back to saving for our retirement or saving for whatever goal we have, then getting it right, getting the structure of your investments and portfolios and protection, everybody. Let's not kid ourselves. Financial advice covers a whole multitude of sort of the whole broad spectrum. But you should talk to your advisor. They can make sure you're not making those mistakes early on. And I think people often think, oh, it'll cost me a fortune. It won't. It's money well spent, whatever it costs you. But it doesn't cost a fortune. I mean, often you'll get your first consultation, at a very competitive rate, but reach out and take it, because it's like building a house. If you haven't got the foundations right, it will fall down. So reach out and talk to your financial advisor, and come to us if you haven't got one. We can make sure that we're putting you in touch with the right people.
Great.
Thanks. For me, just jumping in there, Steve. I think for me, it's very much around peace of mind as well. Mm. The reality is that we're all in control of our own destiny now. The reality is that we all need to understand our own individual financial situations, and we need to understand how and when we can retire, what our expectations are, and whether those expectations are realistic. And I think unless you do actually sit down with an advisor, then you're not going to get that information. The reality is everyone's circumstances are personal to them. So that means, you could try a kind of robo-advisor or something like that. But the reality is that, that's too general. What you need is someone, as Loraine was saying, looking through your own personal expenditure, looking through your expectations. Do you want a Lamborghini in retirement? Is that realistic? You need someone there to help you, but I also think you need someone to have an honest conversation with you as well, and actually potentially to talk you down and say, well, look, unless you save a lot more money, then the reality is that you may not get exactly what you want in retirement. And I think that's where kind of face-to-face personal advice really shines through.
I think if I can add to that, if there's nothing that needs to be done, the advisor will tell you that. Mm-hmm. And therefore you've had free advice. They've explained what can be done, and there's no shortfall. But in my experience, very few people are in that position. And I can add, the sooner you talk to someone, the better. It's never too late, but the sooner the better. It's important.
I think that's a valid point. And how do you, as an advisor, how do you sort of peel out them objectives from clients of what they want to achieve, so you can set that financial plan?
Well, I say a lot of it is down to the initial discussion around expenditure and what they want to do. Mm-hmm. But forewarned is forearmed, isn't it? And you need to understand what actually the capital value is of your goal, and then what perhaps the consequence and what may you have to forego if you don't actually have sufficient income in retirement. I could also add that Steve mentioned capital gains tax, which is an important allowance many people overlook. And there's also the use of spouses transfer of capital between spouses that's exempt. Many people overlook. So it's better to speak to someone and at least do an annual review. I think that's so important.
Yeah, agree. And we'll slightly just, going into the subject to you, Loraine, just changing it slightly. You mentioned right at the start of the session that you used to work as a business advisor with businesses in terms of giving financial advice. And I'm aware you still have some clients and work with business owners. Can you just tell me a little bit about sort of how you sort of do from a financial plan for someone, from a business perspective?
Absolutely. It's largely dependent on if we're talking about protection needs, then clearly that's a different subject regarding what happens if a shareholder were to pass away, etc., and what position would the business be in, and more importantly, the remaining shareholders. But in terms of investment, then if the company has got laden with cash and retained profits, then it largely depends on whether or not the capital needs to be retained within the company. For example, if they've got future plans to purchase more machinery, premises to a degree, but that can be done in two directions. But nevertheless, if the capital needs to be retained within the company, then it's a discussion around what their objectives are and the time frame for investment. So if not, then in my experience, mostly direct shareholders are quite interested in extracting profits tax efficiently. So, for example, into pensions like a company SAS or in SIPs or personal pensions, then if that's the objective of most of the family businesses and the corporates that I've worked with in the past, because we're all in business to make money. I mean, that's the reason for it. So if you can extract those profits tax efficiently, and the company can get corporation tax relief from that, and there's no taxation for the individual directors, then that's a good outcome for most of the businesses that I come across.
It's this time of year we see an increase in employer contributions just before tax year end in terms of accountants sort of advising, in terms of getting funds out of the business, and an efficient way of doing that is paying into your pension. So it's quite a common thing that we definitely see. And just flipping over to you then, Kristen, so talking about sort of retirement planning, you have the option of income funds versus accumulation funds. Can you just tell us a little bit about, we've spoken about these before, but I think it's worth re-echoing what they are and why you potentially would go into one versus the other?
Yeah, sure. So, basically, when you look at an investment and you look at something called the total return, it's basically a function of two different things. So the capital value, but also the income side of things. So I'll make it really simplistic. Imagine if you just held a number of shares in a certain company. How does that share price get bigger? How does your total pot get bigger? Well, it could be that the company does well and the share price increases that way, or it could be that they pay you a dividend overall and you get income from that. If you think of a dividend it's a little bit like, say, interest on a bank account in some ways. And what you get is, we have here at TP a choice of what I describe as income portfolios or non-income portfolios. Now, if you have someone who is looking to take an income, let's say, they're in drawdown, let's say that they use their investment to live off, they want, £1,000 a month, £5,000 a month, something like that, then there's two ways that they can facilitate that with true potential. So firstly, they could take a natural income through our income portfolios, or what they could do is they could sell units and hold a non-income portfolio. Now, the reality is, in some ways, it's down to client preference, and it's down to really what they like overall. But what I would say is, if you have a large need for income, then an income portfolio is a good way of basically avoiding something called sequencing risk. Now, sequencing risk is basically where you're selling units in a falling market, and it's very difficult to make that money back up, make that capital value back up. But obviously, with an income portfolio, you don't need to sell units, so you don't need to touch that capital overall. So for me, I think someone has a kind of big need for income, I'd always recommend an income portfolio. But again, it's client preference. It's what clients like, and different assets produce more income than others. For example, an income portfolio potentially may have a little bit more of a UK skew, because the UK is the highest yielding region right now. So you just got to think about that when you're looking at the portfolios overall. But yeah, if someone needs an income, then I'd always recommend an income portfolio. Brilliant.
I think that's important as well. Steve, I'm just going to come over to you and just ask a question on the fly. Your experience with it, obviously lockdown, we're hoping is going to end soon. In the next few months, who knows? How have the advisors found this out in terms of working with clients in this very different way? And I'll pass, once you finish, I'll ask Loraine the same question of not being able to go and see clients. What's it been like?
So you'll ask me, Jamie, then Loraine will validate then what I say or not.
Yeah,
so
basically.
yeah, it goes. Let's cast our minds back 1 year, which seems a long time ago, doesn't it? Even though it's Groundhog Day, I sit here every day, look out that window. I've moved around the house, different rooms to try,
I was wondering if that was the doghouse for you, Steve, behind you.
Not yet. If she finds me in the tree with my chainsaw this weekend when she comes home from work, I'll be in the doghouse. Unless I've chopped my arm off, then I'll be in the hospital. But no, cast your mind back a year to sort of February last year. We had the rumblings. COVID was building up, and it was sort of what none of us could believe. Kind of what we might have to do. It was an unreal kind of scenario. We were preparing for that behind the scenes. We kind of, as it sort of cantered into February particularly, we realized something was happening. The beauty we have is we have a very strong technology base, which, if you're all our clients, you'll be aware of it. So it was really going to be tested. We felt this was coming now, and our reliance on a high quality tech base was going to be tested. So we positioned accordingly. We made sure all our communication lines were open with the advisors and our clients. We started a whole series of planning for sort of webcasts like this, and one-to-ones on the phone. And also making all our staff work remotely. That was quite interesting, that you're all going to be working from home, which probably sounded rather exciting for the first week, and then you get podcast 56 in, and it's still very exciting, as we can all tell. So we were preparing behind the scenes, but we were really lucky in the sense that we have built some other things, but we didn't generally have to build the core of what we were offering. So when it happened and Boris stood up on that Monday night and said, right, I'll go home, we were ready and positioned, and we had a few teething problems. It's like all the parodies you've seen, not quite Handforth Parish Council. We haven't had many of those meetings. You've got no authority on this site, Loraine, but you have today. We didn't have any of that kind of stupidity, but we were ready. And once we got through the few teething problems of people being on mute, it has worked really well. It's worked so well that you think, why are we ever going to go back in the office? But we'll deal with that at a different time. It's worked really well because we've got, as I say, that core of technology that serves our clients, so they can serve themselves online with an advisor in the background. We can talk to our clients and our advisors. It has worked really well going through the year. We've learned from it. We've amended a lot of our processes and built other things. In times of war, research and development canter along. So some of our functions we've really improved and built on. A lot of our client-facing technology we've refreshed, and our advisor-facing technology we've rebuilt. So it's been a really interesting year. But in a nutshell, and I'll stop rabbiting on, it's worked a lot better than you could have imagined, to the degree that we have had a record year, and we've kept all our investments going. The team meet online every day, and it's been really interesting. We've learned a lot, but thankfully, just by having those lines of communication, which are really crucial when things are going well, people generally aren't that fussed about talking to you. They've got better things to do. When they get a little bit frightened, it's crucial that they have, they know how to contact you. You're being proactive in contacting them. And that's the same for our advisors and our clients. So we're really pleased with the way it's gone. But I'm ready to go back in the office some days a week, because I do miss a bit of human contact. My wife's gone to work, so she can't hear that, so that's fine. That's the kind of human contact I get from her is often a clip around the ear. But yeah, that's my take on where we've been with this odd, horrible year. Loraine, is there any truth in that? You're seeing it from a different perspective, but hey, maybe I'm wrong.
Question again? No, I'm joking. I've really missed the people. I have my clients, and many of them I've had for 15, 20 years. So genuinely like all of my clients, and I love the job. So I've really missed that social interaction with clients. And but we get by. As you say, we're in the right place at True Potential. We've got the technology, we've got the systems to facilitate remote reviews, etc. I think the one area where it's proved more difficult, I think, is gathering new clients. Simply because I personally do like to meet people when I'm doing business. I think that's important. But again, we've got by, and we've managed with the technology, Zoom and etc. and Teams, which we're on now. Although I've never used this one before, which is why I had a problem with logging in this morning. But yeah, Zooms work fine. I think if you keep in touch with clients regularly anyway, which I think is important, then clients don't fret so much and don't worry so much, and they know I'm always around. So I think all good advisors will say the same. You just need to keep in touch with people and know that the door's always open. They can ring you or contact you.
Yeah. I agree, Loraine. I think transparency is the key, and having your website, having access to your advisor, being able to discuss with them, that's definitely a key area. It's when I spoke to an advisor in the middle of this week who said it's very similar to yourself. Ongoing servicing with clients is fine online, and you're kind of used to that, although you miss that social contact with people. But with new clients, you sometimes do just like to sort of get to know them a little bit with that face to face. But unfortunately, he has had to just get on with it. And he's, I've personally advised 3 clients I've never met before online. And so you definitely can do it. It's just a little bit different, isn't it? And then sometimes you do want to, you get to know the client and them to get to know you and trust you, because it's a very, it's a trusting job because you're dealing with their money. So it is really important. Brilliant. I think we'll wrap that up. We've had some really good content there. I'm laughing in surprisement, Steve. I don't know why, but
yeah, I don't know why, Jamie. Either. Why is that? Is that because you don't think I'm funny, or?
No, I think you're very funny, Steve. Funny looking, but very funny at the same time. Right. Well, we'll finish off, and we'll ask Loraine. Did you score any goals for England when you played for them?
No, I don't think I did actually. I can't recall any. I'm sure I'd remember if I had.
And Steve, did you score any goals for England schoolboys?
No, I don't remember. I don't remember. I probably didn't, Jimmy. I'm like Loraine. We're from Yorkshire. We'd remember if we had. And other people would know about it.
We're not out over the halfway line. No.
Exactly.
And Chris, you haven't got any caps for England on lasagna making or something like that, have you?
Yeah, if you ever see me play football, it's definitely not my best skill, put it that way. So there's definitively no goals. Never mind for England, there's just no goals anyway.
I didn't have my glasses on, but for most of this podcast, I thought Bobby Charlton was on with us, but no,
I haven't got the little strands though, have I? That's the thing. I'll grow them for you though.
We'll finish off. So obviously the lockdowns, hopefully Boris is going to announce them on Monday, where we're seeing some light at the end of the tunnel. The vaccine numbers have been fantastic. I think with 16 million now. I'm due mine next week, hopefully, touch wood. But what's the first? I'll start with you, Loraine. What's the first thing you're going to do when you can get back to normality?
Oh,
put your football boots on.
A nice long walk in Derbyshire, the Peak District, and a pub lunch.
Yeah, that sounds good. Mr. Hutton?
There's a little pub in Keighley called the Boltmakers Arms, Jamie, and it's like someone's front room, but it's the tap room of Timothy Taylor's. And I'm not going to let on around here, but I'm going to go sit there with a newspaper, a print copy, not something on a blooming screen, and I'm going to have a couple of pints and just be in touch with myself, as it were, with a pint or two.
Fantastic. And Chris?
Probably missing 2 things. I'm missing the pub, and I think definitely as soon as the pub opens, I'll do exactly what Loraine and Steve said. Go enjoy a few pints, a nice meal, something that's not home cooked, which would be great. And I'd really like to go on holiday as well. Go get some sun, relax, have some nice drinks, lie on the beach, nice food, swim in the sea, just relax. I think would be fantastic.
What are you going to do, Jamie?
I don't know. I was talking about this. I would like to go on holiday. I've obviously got the little one. I want to get him on I thought when we first sort of fell pregnant, I thought, great, I'll get him on a plane straight away to get used to it. But he's at the point now where he's starting to wriggle and move, and he's turning over and potentially starting to crawl. So that's going to be, you'll have experience of this, but that'll be interesting on a plane with a little one. That's my plans, but I'll have to challenge. There'll be a challenge.
Do a film about that, Jamie. But let's think we could call it Snakes on a Plane or something.
The worst film ever made, Steve.
I've never seen it.
It's terrible. It's terrible. All right, brilliant. Thank you, everyone. I think that was a fantastic session today. So thanks, Chris. Thanks, Loraine. Appreciate you coming on for us today. And thanks, Steve. We'll end that there. As I said before, please like, subscribe, give us any comments in the comment box, positive, hopefully. But thank you very much, everyone. Hope you have a great weekend. Thanks, everybody.
Thanks, everyone.
Thank you.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.